Welcome back to this continuing series on real estate investing mistakes to avoid crucial mistakes that you can't afford to make. And if you stick around until the end of this video, you're going to get a new slant on passive income that you've never heard before. Hi, I'm Keith Weinhold. This is Get Rich Education. First mistake really relates to thinking small, and that mistake is avoiding financing. Okay, look, do you think that real estate prices are going to be higher over the long term? Do you think real estate prices will be higher, say, 10 to 20 years from now? In almost every instance historically over a long time period like that, the answer has been yes. Well then, would you rather have one $200,000 rental property completely paid off, or would you rather have that same equity with 20% into each of 5 properties? Well, you'd probably rather control 5 properties because you'd have $1 million worth of 200K properties. So therefore, at the long-term rate of appreciation of about 6%, here your one $200,000 property would give you $12,000 worth of returns per year through appreciation. However, if you have 5 200K properties over here, each with 80% loans on them, that's $1 million worth of property. So 6% appreciation gives you a $60,000 gain here versus just $12,000 over here due to the fact that you have financing. And that gives some people pause that are new to this. They say, well, whoa, wait, what about the debt? Now, we didn't remember that in a cash flowing rental, your debt is 100% outsourced to the tenant. Inflation is also debasing the amount that you owe back to the bank. So both inflation and tenants already effectively pay this down for you. Also, you can say that interest rates are lower than the rate of inflation during this time. When that's true, your prosperity actually increases over the long term when you are a borrower. You want to be a savvy borrower. What it allows you to do as well when you have 5 properties rather than just one is with these 5 properties, there's less risk because you can spread these properties around into different markets and different neighborhoods. You've actually reduced your risk. Another thing that financing does is, this is something you have to pay for when you come to the closing table, is an appraisal. Because when you get a loan, the bank basically uses an appraisal to check the quality of their collateral that you're borrowing against. That makes a lot of sense. Well, this appraisal, this actually acts as a third-party independent evaluation of the value of that property. That's worth something to you. It helps you avoid overpaying. Now, another mistake that real estate investors make is often getting the wrong financing. Oftentimes they get too short of a mortgage term. The loan that you want to use in almost every case for a rental property is actually the same one that you would use for your home. It's very much the same, a 30-year fixed rate mortgage. Yeah, you actually want the 30-year, not the 15-year. I made a mistake early in my real estate investing career. I had put a 15-year mortgage on a property, and it's only when I wised up to the fact that this really is not helping me out that I actually refinanced it over to the 30. First of all, in rental property, when you have to make a 15-year mortgage payment, you need to make a higher payment because you need to get that loan paid off in 15 years rather than 30. So your payment on a 15-year loan might be, say, $600 per month higher than it would be for a 30-year loan. Well, that's more likely you're going to have negative cash flow on a monthly basis then. And some people still hold out and say, no, the 15-year is a lot better because look, not only do I get it paid off faster, I'm paying a lower interest rate, and I can show you right here on an amortization schedule comparison between a 15-year and a 30-year that look right here in the 15-year in black and white. It says I save, say, $80,000 in interest payments over 15 years by going with the 15-year rather than the 30, but they're not looking at the whole picture. Rather than that $80,000 of interest rate savings that you just used to pay down your loan faster, what if you took that $80K and invested it? What would the rate of return on that be? If you took that $80K into, hey, that's enough for 20% down payments on 2 more $200,000 properties. You could use it that way. Or Even just use it to improve the quality of your life and go on a vacation rather than rushing to pay down low mortgage rate debt. Run all of the numbers, not just how much it would save you in interest rate. You've got to understand the opportunity cost of putting $80K into equity. As we know, the rate of return from home equity is always zero. Also, with a 30-year loan, if you want to, you usually wouldn't, but if you want to, you can accelerate the pay down and make extra principal payments. You do have that flexibility with a 30-year loan. With a 15-year loan's higher payments, a $600 higher payment per month in this case, you must make that payment or you're defaulting. So the 30-year gives you more flexibility. So use financing, use the right financing. Again, in real estate, oftentimes a good answer to many questions is it depends. Now, in rental properties, if you're single, you can get up to 10 financed properties at the best rates and terms with those Fannie Freddie loans at the lowest mortgage interest rates. Or if you're married, you can get 20, 10 for you and 10 for your spouse. So you might say, well, hey, a market like Memphis where property prices are really low, like $75,000, then an 80% loan would be $60,000. Well, do you want to use your precious loan spots on $60,000 loans? There's very little limit to the loan size. They go up pretty high with how many you can put in to those 10 or 20 unit categories. So therefore, maybe you do want to have paid off properties if they're a really low value property, because you don't want to tie up your precious loan spots when you can use one of those same loan spots for a $200,000 or $300,000 loan. That could make sense in that case. But the overarching theme here is, remember that paying down property, what that does if you pay extra principal payments is you convert your cash flow into equity. Financial freedom is achieved by doing the opposite thing, transferring equity into cash flow. That's another huge reason why you don't want to accelerate principal pay down. It really doesn't pay off in the long term. Hey, go ahead and put a YouTube like on this if you like some of these ideas, avoiding mistakes and really dispelling a lot of these conventional mindsets or old-fashioned mindsets of paying things off when interest rates were way higher like they were 30 and 40 years ago. The next real estate investor mistake is not investing in the best markets. I touched on this a bit in previous videos, but you want to invest in landlord-friendly markets. Oftentimes that's not in a state where you live. Landlord-unfriendly markets include many of the cities in places like California, New York, New Jersey, Connecticut, where it could take you months or even more like a year to get an eviction if your tenant is not paying the rent. There's kind of a humorous name for people in some of these places like coastal California. They call these people professional tenants, people that plan to rent a place from you, but know they don't have to pay the rent because they know how to circumvent the law and get away without paying rent for sometimes a year or more. But investor advantage, landlord-friendly markets like Arkansas and Tennessee and Georgia and inland Florida and northern and central Florida. These are the sorts of places that tend to be landlord friendly. You can get an eviction for a non-paying tenant in just a few weeks in some cases. And you know, in these areas of the Midwest and South, those are generally where the numbers tend to work anyway. So it's a pretty nice coincidence for you as a real estate investor that landlord-friendly markets often tend to correlate with those that are most profitable from a standpoint of a ratio of rent income to purchase price. So avoid landlord-unfriendly markets. The next mistake is people endlessly self-managing. Now, if you do happen to own property in your local market, I think there's a little something to be said for managing your own property in the beginning, because thereafter you will sort of understand those property manager statements down the road better. You'll be able to interpret those better for the rest of your real estate investing career. But some people continue to be landlords, and they will often be landlords in investor disadvantaged markets like, say, a Connecticut. If someone owns rental property, and we'll just use Connecticut, and they're getting a rent-to-value ratio of 0.4%, not an investor advantage market, and oftentimes they will manage that property themselves, and they might live a life where they have an old pickup truck with some paint cans and some sawhorses that are in the back of it rattling around all the time, and that's okay. You can do that for a little while, but you're probably not profitable. You probably don't know how to run the numbers. Look, you can invest in investor advantage markets and get rent to value ratios of 7/10, 8/10, or 9/10 of 1%, maybe even close to a full 1%, and pay a property manager. So yes, there are people that invest locally and manage themselves that are less profitable than you that has the wherewithal to invest in investor advantage markets and have it be relatively passive because you're using a property manager. You are more profitable even though you might have never even seen your property, and you're not reducing your quality of life that way by self-managing and having all the tenants that have your phone number, so you don't have to self-manage endlessly. And by the way, a property manager, they collect the rent, they handle all of the tenant relations, therefore the tenant does not have your phone number. They don't even know how to get a hold of you. I want to know that those tenants are being taken care of, but as soon as I get involved with doing it directly, my quality of life diminishes. Your property manager also manages all of the contractors. If they have to subcontract out a plumber or an electrician and then they bill you for that, that just goes on your monthly statement at the end of each month. So your manager sends you a statement at the end of each month, and it's basically a ledger of your rent incomes that they're managing in your portfolio and whatever expenses that you have. They do all of that for you. And it also makes it easier at tax time because your manager has itemized all this for you. And of course, along with your monthly statement comes that crucial rent income that's automatically deposited into your bank account. You can even have the property manager make your mortgage payments for you too. With most or all of my properties, I don't have them do that. I kind of want to be sure that mortgage gets paid. So therefore, I get the rent income, so pretty substantial rent incomes without that mortgage deducted out. And then I also see in my accounts that, oh, the mortgages were paid monthly for each individual property. That's how I plan to do it. But your manager can even pay your mortgage for you. Your property manager, they know the landlord and tenant laws in their local market. They know what they can get away with and what they can't with tenants. They have all the proper notices for posting tenants if the tenant would happen to be late with rent, or if the tenant's not supposed to have dogs and they try to have a dog in their unit. So your landlord, being that property manager, they know all the ways and means and the processes and how to deal with these things. And they also act as a buffer between you and the property. They tend to be less emotional about things because they are not the property owner themselves. And by the way, I don't know why anyone is a property manager unless maybe they're a real estate investor themselves. I would not want to be a property manager. The big reason why property management is so difficult is property managers serve two masters, both you, the investor, and the tenant. Just say, for example, the tenant has a noisy dishwasher. Well, the landlord might feel uncomfortable asking you as the property owner to get them a new dishwasher. They might therefore have to push back against the tenant and ask them to tolerate a little noise or something like that. So there's always this friction, this difficulty with that property manager having to serve two masters. The next mistake is thinking that passive income from being a direct real estate investor is indeed passive. It's not quite passive, but it's pretty close. Now, even though I use property managers, I still get an email from one of them once in a while in all these various markets where I have properties, and maybe I'll have a decision to make like, well, Keith, do you want to pay $200 to repair this air conditioner, or we got an estimate over here and they think it's probably better, the HVAC company, if you replace the entire thing. So I might have to make a decision that way once in a while. It's not completely passive. At the end of the year, I do need to make sure things get transferred over from my property manager to my tax preparer in the right way. So it's not completely passive, but it's pretty close. And the funny thing, let's say that you have a day job, you work 52 weeks a year, and let's say you have 4 weeks off all year between vacation time and a few holidays that you have. Well, therefore, your income from that job, we could say that it's like 92% active income where you actively have to be working to get that income, and only 8% passive when you have vacations and holidays. With real estate investing, using property managers, I would say for me, it's probably 99.5, maybe even 99.75% passive. I don't have to get involved very often at all, but once in a while things do come up. So it's not 100% completely passive, but your day job income is almost completely active. Passive income means that the money recurs with or without my involvement, and that's almost always what real estate is, but not completely. Hey, go ahead and put a YouTube like on this if you like learning about mistakes to avoid in real estate investing. Maybe if you like that take on passive income. Yes, it exists in real estate, but it's never 100% completely passive. It's just really close. I don't want you to make mistakes because then real estate kind of gets this negative stigma or a negative connotation, and then you're just turned off by the whole thing. So if you can avoid these mistakes earlier in your investor career, you're going to be a lot happier long term. And maybe with all these mistakes you're hearing about, you're thinking, gosh, is real estate investing even worth it? If you're brand new to this, check out my video series, The 5 Ways That Real Estate Pays, right up here. A lot of experienced real estate investors, billionaire real estate investors, don't even understand that you're often paid 5 ways at the same time, such that returns of anything less than 20 to 25% are actually disappointing. So you need to play a game worth winning, and that's just exactly what real estate is. Most investors are only used to getting paid one way if the capital value of their asset goes up. Wealth is created really predominantly one of 2 ways, either through entrepreneurship, which is very involved and it's riskier, or real estate investing. This is a game worth winning. And the last mistake is, don't be a control freak. Too many people are control freaks about their real estate. And a lot of this has to do with handing off your property to a manager. Some people want to get that last 2% toward perfection so they won't use a manager, and that's a big mistake because you pay for that with your time and you're never going to get that time back. For example, between a tenant turn, if a tenant had lived there previously for say 5 years and the walls need to be repainted and the manager does that, but there's still some little pinholes there in the wall that the manager sends you on the video between turns, that doesn't really matter that much. The incoming tenant, oftentimes they're going to put another picture or something on the wall right there where it is anyway. So it's about not being a control freak. When I self-managed in that first ever fourplex I bought, I remember between tenant turns, I would get down on the floor and get on my hands and knees and try to touch up the baseboard down toward the floor with like this little brown marker and everything, because I didn't know why the property wouldn't rent out, and you could hardly see these little nicks from where you were standing up. It was ridiculous. I was too much of a control freak. When I pulled back and understood about what's really important in life and outsourced things to a property manager, my life got a whole heck of a lot better. Hey, well, I hope that you're enjoying this multi-chapter series on huge real estate investing mistakes to avoid. Hey, go ahead and put a comment below if you would. I will reply to those as long as I possibly can. You know that it's me because I'll put -Keith on the reply to the comment. Let me know what you think, and if you know of some other huge real estate investing mistakes that you've made, I appreciate you joining me for this series. My name's Keith Weinhold. Thanks so much for stopping by. We'll see you in the next video.